Hello, everyone, and today we're going to be talking about how to start investing in 2020. That's right, a time in which the market is extremely volatile. Now is a fantastic time to actually start. If you haven't started investing, this is a fantastic time for you to get into the game. I'm going to just explain some things for you, talk to you about what exactly you need to do, what you need to look at, and how you can possibly get involved in the game. So, first off, I think we need to discuss the current market conditions because I think it's fair. I think there's a lot of people new to investing that don't know exactly what to do in these current market conditions. A lot of people get very afraid because they don't want to lose money, right? So, the idea that they typically will present is to panic sell. Let's just take a look at the Dow. In the past month alone, the Dow is down 26.5%. That is insane. The Dow posted its worst point drop day in history a couple days ago, actually. So, and as far as percentage is concerned, today it looks like we might have yet another one. But percentage-wise, it was the 11th most or 11th worst day in the history of the Dow Jones. And you look at that and you may be considering, why in the world is this the right time to get started in the market? Well, I think there's a lot of reasons for it. My main perspective is I think everyone knows the adage of buy low, sell high, and that frankly is just the fact. We've gotten to a point previously, prior to this big drop, and you really can see here, if I make this the year-to-date chart, you can see the big dip we've had. And overall, buy low, sell high is really there for a good reason. That is frankly how you make money. These times of volatility and negative market movement are fantastic for building positions because this is when the shares are cheaper. Prior to this big drop, shares, and to be fair, price to earnings ratios, which we'll get into in a little bit, stocks weren't quite as fairly valued. We're at a time after this dip where I think valuation is getting a lot more in tune with what we like to see and what you might want to look at whenever you're planning on purchasing stocks. So I think overall this has been a crazy and uncalled for change here in terms of stock price and just how things are going. But I think it's a great time for you to get started. And during times like these, the most important thing I can say is, well, you gotta be patient, and you have to actually have some cojones. I know I shouldn't say it that way, but frankly you do. You gotta know that you can accept this loss tolerance because frankly, you haven't lost any money until you sell it at a loss. It's not justifying any negative trading in bad companies. Obviously, the main thing is picking a good company too, because if you're in solid companies during these bad times, you don't need to worry about the fact that they're going to come out on the other side and absolutely rock it. You don't have to worry about that. There's some sketchy times in which you get into recession type environments that these smaller companies that can't really make a profit, a lot of these times that's where you find an issue. So I think it's important to get into a couple sectors here, and while I do, I will discuss what's going on. So my first example will be, well, obviously one of the biggest tech companies in the world, no doubt about it, and that will be Apple. And everyone knows Apple. I chose Apple for a good reason. Everyone knows what Apple is. Right here, I'm just on Yahoo Finance. It's one of the main websites I use to look at just financial data for these kind of companies. So what we like to see for Yahoo Finance on Apple. So what I like to do is historically, they'll show you a couple of key things here, and I will highlight them for you. One being market cap. So pretty much market cap is going to be the value of the company added up from shares, all share value, everything added up in that company. How much is that company worth? So if you were to buy this company, how much would you have to pay to buy that company? So to buy Apple, you would have to have $1.28 trillion, and I know we all do, so why don't we? Maybe if 500 million of us team up together, well, even then, no, 500 billion, debatable. Yeah, we're going to need at least 1.28 trillion people, to be fair, if we want to have a chance here. Anyways, but that is how much this company's worth. So this company, Apple here, is worth $1.28 trillion at the moment. And you can look historically from 2019 to previous quarters here, how that has changed. And that has changed pretty drastically, even just in the past year, 2 years, just frankly off of the fact that this company is continuing to be a growth beast, growing in revenue. So they grow sales, they grow profit, they grow it all. And they have a lot going for them. So what do we like to look at next? It'll be obviously a couple things down here is your trailing PE. So what is a PE? PE is a price to earnings ratio. It's a pretty simple formula here. Your price divided by your earnings. So your earnings per share, meaning how much money that company makes in terms of profit per share. So every company obviously reports in earnings per share. There's both a non-GAAP EPS and a GAAP EPS. A GAAP EPS is going to be the generally accepted accounting practices. It's really just a steady set of terms that all companies really have to go by for the most part. That these set terms, this is what they look at, and this is what they take into effect to actually calculate whether a company's making money or not. And then there's the non-GAAP, which the companies can tend to mess with those numbers a little bit more and include some other stuff and not include some things. And typically you'll see a non-GAAP EPS higher than the GAAP EPS. The main thing you need to look for, obviously, is you want a company with a price to earnings ratio. So there's many ways to how a company can have price to earnings ratios. Well, the main way, obviously, is if you have a negative earnings or no earnings. Obviously, we all know dividing by zero doesn't work, okay? But we also know if we're dividing by a negative number, that makes the whole, the solution of the problem negative. So that price to earnings ratio negative, there's not really such a thing as a price to earnings ratio that's negative. It frankly doesn't exist. So typically you'll see a not applicable for that. So if there's no price to earnings, there should be concern about the company because you need to know about what profit they make. The concern there with companies not making profit is the company going to be able to get to a point wherever it does make profit? That is one that is obviously important and it remains to be seen, but that's why you do research on stocks like this. So you have to know if the company has a plan for potentially getting to that profitability and earning a price to earnings ratio, then that's what matters. And typically you'll see that in the forward PE. So the forward PE pretty much is going to be based off of next year's future growth in earnings over the price. So this shows in the future what that company's value technically could be based off this price to earnings. But the forward price to earnings, it's comparing it to next year's earnings. So you can see pretty much if this company is actually valued fairly for what this future growth looks like. So you see here Apple trading at a current or trailing PE ratio of 23, where a forward PE ratio is a 22.12. So you see that based off future growth and earnings, this company is obviously expected to grow earnings because this price to earnings is less than the current price to earnings. So they're expected to grow earnings and increase profitability. Exciting stuff for them. So next you have a PEG ratio, which is a 5-year expected rate of growth. So PEG, price to expected growth. This is pretty much the price compared to how much this company is expected to grow in the future over the next 5 years. So typically, you're looking for something to, it depends on the stock. Again, just like with this price to earnings, what fair value is for a price to earnings ratio. Typically, you're going to be looking somewhere from the 15 to 20 range. Historically, that's fair value for stocks. But not all stocks will trade at that because some are going to be more valuable than others. A company like Apple growing revenue 10% every year, you might see them earn a little bit higher of a price to earnings ratio because, well, they're a company that can prove that they're successful, so investors might buy more. Price to expected growth, you might want to be looking somewhere around 1, but for a company that's expected very high growth, you might be looking somewhere closer to the 2 to 3 range, and that's that might be fair value for that company. It all really depends on the company. Price to sales, again, which would be a price to sales, which is really just going to be your price to revenue. Price to revenue, that's measured in a TTM, which is trailing 12 months. So over the past 12 months, we're comparing the price to the how much sales this company's done. And price to book will be price over the total value of the company. So you see Apple here, price to book is very high. And again, for both these price to sales and price to book, looking around a 1 is pretty fair for them. But with a company like Apple, you can expect that to be higher. But for a lot of companies, fair value might sit around 1. You're getting a good deal on a company if the price to sales is 1. I think is a fair way to say that, because clearly investors aren't valuing it that highly. But it also depends on some factors. What else I like to look at when we look at these type of companies? Well, obviously we like to look at profit margin as a key thing, and then we'll get into the balance sheet here shortly too. So let's look at the financials of the company. And I won't do this for every company, but I'm just going to do this here for Apple because I think they're a fantastic example as the biggest company in the world, really. You see, Apple, what I like to look on this financials tab is you see a difference in total revenue. So total revenue, everything they've made in terms of money, you can see a difference year over year, how they've grown sales. From 2016 doing $215 billion, that's right, $215 billion, to on a trailing 12-month basis doing $267 billion. So they've, in 4 years, made over $50 billion more in revenue than they did in the past 5 years. So those numbers are significant. Actually, it's really 4 years, but that's significant growth. And that's what you really look for in a company is you want to see revenue growing. If you see a company on a revenue downtrend, you might concern yourself with why is that? Why is the company not growing when typically you want a company you're investing in to grow because you're investing thinking this company will do things positive with your money. But if they're not growing, they really won't. Other than that, obviously, we like to look at a gross profit line. So gross profit will be your total revenue minus your cost of revenue, so how much it costs to run the business, everything like that. Your gross profit is how much money that they've made after you've taken the expenses out of the total revenue, especially the cost of revenue. Then you have your operating expenses, so really the cost of doing business here, from research to selling, general, and administrative. These are obviously things to look at because if the selling, general, administrative line goes up, that'll typically increase with revenue. But if there's more increase in research and development, you might question why is the company spending a lot more on research and development, and is it actually worth that company? So we like to look for, I think one of the best things to look at is going to be the net income line. So net income is after all expenses are taken out, what kind of profit is this company bringing home? What are they bringing to the bank? So for a company like Apple, you see a very positive net income line. This company in the trailing 12 months, past 12 months, they've brought home $57.5 billion, just completely revenue or completely profit. They don't have any expenses after that. That's that's $57 billion that they own now in a 12-month period. Crazy stuff if you think about it. So that's what I like to look at the financials. But when we're looking at that as well, I think we like to look at the balance sheet too. So on a balance sheet, there's many things to look at. Obviously, you want to look at cash. So cash is, again, how much money that company is hoarding, how much money they have to spend on many things. So total cash is a big part, but then you add in some of the other things, and you get the total current assets. So total current assets is key stuff. It's very key. And then obviously we have, after you include stuff like goodwill, property, you get the total non-current assets, which is really just your total assets in general. And if you combine the two, your total assets will be right here. You see a $338 billion this company has in just cash and cash equivalents laying on hand. That's crazy. Then we go down to the scary stuff, which is the liabilities. The liabilities, how much this company owes in given sectors. So definitely some scary stuff. Accounts payable is how much they owe, in a short-term basis. So their total current liabilities here of 105 billion, which is, again, you look at that and you compare it to the total current assets. So they've got $62 billion more in assets, or $60 billion more in assets than they do in total current liabilities. So that's a very, very good number in terms of a balance sheet. From a long-term perspective, you see a long-term debt number. So total liabilities after that long-term debt's included. Debt's very important because you need to know if a company can pay that down. A company that can't pay down their debt, frankly, they go out of business because they can't pay down their debt. But from a total liabilities perspective, $250 billion for this company, but a total assets of $338 billion. So this company's got a lot more assets than it does liabilities, and that's what I typically look for in a company. You want a company that you know is going to be growing assets positively, because how else are they going to pay down debt if they aren't making that net income line? If their assets outweigh their liabilities, it's going to be difficult to really get in there and change that and fix that. So nothing too crazy with that. That's what I look for in a company. That's really what I'm looking for in a company, if you ask me. So that's the key metrics you need to look for. Now I'm going to get into different sectors. So Apple will cover we'll get into more big tech after that. First, I want to cover, obviously, how are these industries doing retail. So specifically, I chose a clothing retailer for a good reason. Clothing specifically is impacted by the current market conditions regarding supply chain for certain areas. Kohl's is a stock that year to date is down 51%, which the market's down 28% year to date, or 23%. Kohl's is down 50%, and this is common with a lot of retailers. If we look at the numbers on these retailers, Kohl's is currently trading at a price-to-earnings ratio of 7.8 and a future or forward price-to-earnings of 7.5. Historically, this company trades around the 11 to 12 range. So obviously, you look at this company and, well, shoot, off a P/E ratio, this company is very undervalued, right? And you'll see that with all retail right now. That's something that you'll learn when you get in the market, is really big investors are who controls the market. So those big wigs and the hedge funds, they control the pricing of the market. And if they don't like a sector or a stock, you'll feel it. So this company may be not fairly valued as opposed to what I believe it was, but really it can't gain that fair value because right now investors aren't buying in. They're not buying into the stock because they're getting told by these big firms not to buy them. So that's really where you see a lot of impact. Just you and I investing, we have very little impact on stock price. Most of it, again, is controlled all by the big wigs. They really own all of it. So we're just along for the ride. But if those big hedge funds aren't liking this stock, that price to earnings is going to stay at a very low rate, and you won't really see growth from it. But this is a company where you see a price to sales of 0.27, which is very cheap historically for them. Price to book of 0.98, again, very cheap historically for them. And enterprise valued revenue, good numbers there. This is a company that is just absolutely killing it in terms of valuation. And I hate that it's getting hit so hard, but it is what it is. So it's common in retail. You'll see a lot of these stocks trading under a forward PE of 10. Now, I do think that means fair value for the companies, but it depends on what Wall Street thinks. Again, let's look at oil. So, and I did mention to say, as far as retail, I think retail is a decent sector to get into. I know there's a lot of fear regarding the longevity of retail and what it could hold for us in the future, if it'll be something that still exists, right? I currently believe that retailers will still certainly exist at a physical level for a very long time. I think there permanently will be physical retailers for sure. And I do agree a lot of the business is transferring onto the online data space. So in my opinion, if you have a company that can trade data, if you have a company that can actually have a good e-commerce platform selling online, I think it's worth taking a look at for a retail stock. But overall, just know what you're getting into. If we look at ExxonMobil now, so we're looking at the oil sector or natural resources, ExxonMobil's down 46% year to date. And this is consistent with all of these companies. All of these companies, oil and gas, have been getting hammered for a lot of reasons. Obviously, oil pricing drops, but just this is a sector that Wall Street hates right now. Wall Street hates the oil industry because really everyone's focusing on future renewable sources of energy. So that is why oil has been absolutely devastated. It will bounce back. But for right now, I say stay out of oil companies. I don't think they're necessarily decent value for you. Next, we're going to be taking a look at, that's right, big tech. And I like to bring up Facebook for this. So Facebook is a company that right now, year to date, is down 23.97. So this kind of mirrors what the Dow's doing. Obviously down quite a bit, but down a lot less than these other guys. And there's a good reason for it. Well, I can't say there's a good reason for it, but investors freaking out. Facebook is a stock that I like to look at the valuation on because it's ridiculous. Can we just take a look at this revenue? So in 2016, they went ahead and put up $27.6 billion. But in 2019, put up $7 billion. So that's a growth of $50 billion, nearly 50, so really closer to $40 billion in 4 years. This is a fast-growing company that right now, if you look at valuation, is trading at a forward PE ratio of 20 per share, 20.24, which is a very cheap valuation for this stock because big tech is a sector that's, relatively high in terms of price to earnings ratios historically. They're companies that investors really like because in the future, a lot of these companies will be doing a lot more than they are now. But they are the future of where the country's going, where the world's going. So I understand the valuation can be higher on this one. But the price to expected growth on this one is under 1. This is a company that grows revenue at such a high pace. It's an excellent pick, and you see a couple of these in the tech sector, but not many like Facebook. Facebook just gets unfairly treated, in my opinion, compared to other stocks. So big tech, I think, is a fair investment choice in 2020. Next, I would like to talk about automotive, and I'd look at Ford for this. Ford is a stock, that's right, you don't like to see it, down 44% year to date. And this is, again, as I should say, constant in the automotive sector right now. Automotive is getting hammered because of companies like, specifically Tesla coming in and kind of hurting their industry. First to release their electric vehicles, really. First mass production of them. So there's a lot of concern regarding these vehicle companies. How are they going to keep up with Tesla? And frankly, I think that they will. I think Wall Street's very negative on automotive stocks, and I think there's a good reason. I don't think there's necessarily going to be a boon for automotive until everyone starts doing these electric vehicles within the next 2-3 years. Again, there'll still be internal combustion engine vehicles, but we'll see how things go once we have electric cars. Electric cars. It'll be interesting to see what the market does for these valuations. Is the valuation going to finally go up? That is one that we don't know yet. So obviously these kind of companies, you can just expect the valuation is going to be off on these. Right now, a forward PE of, that's right, 6.47. Very cheap forward PE. Price to expected growth of 0.46. Price to sales of 0.17. And price to book of 0.81. Very cheap valuation on this company, but it's a dog in the eyes of investors, no doubt about it. I think they're doing good things personally, and I think they're going to be well poised for success in electric vehicles, but to each their own. So be aware of the automotive sector right now as well. Not one that is too enjoyed. Carnival Cruise Lines is my next one. So this is going to be more about the hospitality and leisure type play. So Carnival Cruise Lines own obviously cruises, as you might know, ship cruises, I should say. This is a company that, let's just say, we don't like to look at it because there's a good reason why. There's no chart available, probably for good reason. This stock is easily down over 60 to 70% year to date for many good reasons. With the current conditions regarding virus, traveling is the last thing people want to do, and that's why these type of stocks, from casinos to hotels to these travel stocks, they're getting absolutely devastated because people aren't really wanting to travel for this type of stuff. So that is really what you get. You know what you're getting when you're getting into these. I think there's a good contrarian play. These things could bounce up afterwards. Once we get all of our supply chain issues handled, there's a chance that this could be some good in terms of placement and just everything going on here with the market. So who knows? Keep an eye on this hospitality transport sector. I think it's a very interesting looking sector as far as valuation is concerned. So obviously a company trading right now at a forward PE of 7.62, very cheap, and a trailing PE of 6.45, very cheap. Price to book of 0.78, price to sales of 0.93. The company's trading very cheap. So another thing I need to mention here for you, if you're getting started investing, it's going to be dividends. So here's how I get through times of such nightmares, and it's through dividends. So dividends are really money that shareholders get awarded by big companies because they are owning that specific stock. So pretty much they're paying you back for owning their stock and supporting them. Dividends are fantastic. They can be paid monthly, so every month you could get something. They can be paid quarterly, so every 3 months you get something, or these could get paid, could be annually, biannually, really just depends. Sometimes there's companies like Disney that do biannually, twice a month or twice a year, and companies that only do once a year, which there are certainly a few of them that do that, but just an interesting stuff. So dividends is a key play. So one key number to look at with dividends is going to be, as we look down here, I think it'll be fair to use one of my other favorite websites that I use, and it's going to be Seeking Alpha. And Seeking Alpha is my key for looking at dividends. So you look here in this dividends tab, and it shows you everything. So their dividend yield is again going to be how much they're paying based off the stock of the price. So how much they're paying out compared to the stock of the price will be your yield. Then another key thing to look at is payout ratio. Payout ratio is what percentage of their money that they're bringing in, their take-home money, are they paying to shareholders. So obviously anything near 100% or over is not good because they're paying more profit than they're making. So a company making around the 50 range is good stuff, no doubt about it. A company that's paying dividends is good. You also see a 5-year growth rate. So in the past 5 years, what percentage have they grown it on average? Very cool stuff. And you see obviously they pay quarterly. But if you look at the dividend history, which we like to look at, you see they've been pretty consistently growing that dividend up until really 2018, in which they kind of halted on it. So definitely they have the payout ratio to support potential growth here, but just an eye for what you want to look at. So that dividend yield is pretty much you're getting paid income for owning that stock, and that's what I love about dividend yield. So I like making money on the sideline while I don't have to really do anything actively. It's all passive. You own the stock, they pay you out automatically. You don't have to do anything. So that's what I'm a huge fan of as far as dividend investing is concerned. I try to say a dividend yield should be somewhere around a 3% for a fair value stock in this current market. 2 to 3% is a good looking stock for me in terms of yield, but obviously I own some that yield higher, like Carnival Cruise here you saw yielded, that's right, 9% at this point. 9%. And that's just because the share price has been hit so hard. So nothing too crazy there. Once that share price goes up, you won't see as bad of or as high of a yield, because high yield can be concerning if they can't afford to pay it, for sure. So that's it as far as yield is concerned. So dividend yield is key. You want to invest in companies that are really paying out a dividend because it shows that these companies have excess cash that they're willing to spend. So that's why it's important to look at stuff like price to earnings, so you know what that company's bringing in or what that section's bringing in. So that way you can justify moving product if you have to, whatever it might be. So that would be my lesson on dividend yield for you. Speaking of dividend yields, historically, obviously, we can look at the dividend yields of stocks on the S&P 500. Right now, yielding right around 2.29% on average, where the mean is somewhere around 4.32. So we are a little bit not as expensive in terms of dividend yield. So maybe we can increase the payout ratio just a little bit. Increase some pay on dividends. We'll see. So how do I lay out my portfolio, though? Because we have a selection here. So we've got, obviously, a couple categories. I would say we have a growth. So growth is going to be stocks like your big tech. So we have growth, value, and dividend, which I'll slow down to just DIV. So growth will be big tech. So these are companies that are growing revenue at a pace, I would say, over 10% annually. That's what my aim would be for a growth type company. These companies typically have lower earnings, so they're not making as much profit. That is one thing to consider. But they obviously have that growth to outweigh that earnings and potentially grow. So growth, personally, I think growth, in my perspective, is taking up, in the current market conditions with how far they are, how far the market's down, I'm saying I'm going with a good 40% growth right now. 40% of my portfolio is going to be right around growth. Typically, it'll be somewhere around 30% for me, but right now with how just the market's getting hammered, I think growth's good because they'll bounce back quicker. Value stocks are going to be pretty much, you look at the company and they're trading at fair value. So the company's trading at a good PE ratio, good price to book. That is a value stock. Typically, these value stocks are going to pay a small dividend, but all things considered, nothing crazy going on with these value stocks. Typically, I would say I'll give it around a 20% of my portfolio. Then finally, we have dividends. So a dividend to me is a yield greater than, let's do that. Yield greater than 3% is what I'd like to aim for. 3% or higher is a very good looking dividend yield for me. So this is really just to help build a sustainable pattern for just passive income. So passive income is money you didn't have to work for. The steady stream is what we look for, because if you think about it, down the road, wouldn't it be nice to retire and not have to worry about working? Retire at 65. Really, you could retire at 60 if you wanted to. 50 maybe, I don't know. Just saying. But really, you want to retire early and have your stocks pay for you. In my opinion, I would like if my stocks paid for me. That's just frankly how it is, because if they did, well, then I'm enjoying my life. I don't have to worry about capital appreciation or whether a stock goes up and down if I'm getting paid. So dividend yield greater than 3% for these dividend stocks. And you want, obviously on the balance sheet, you want cash to be greater than debt. And one other thing to look at, obviously for these type of stocks, will be, that is correct. What else do we want to look at? As far as dividend yield, we want, typically you'll want to see dividend growth. So how many times have they grown their dividend, and what can we do to help further that growth? Because obviously we like to sell stuff, and there's no doubt about it. So dividend income, you want a good dividend growth. So you want this company to be able to, further that payment in the future. So that means you also want a low payout ratio when you're looking at a company, because then they have room to grow that dividend. If they're already making near 100%, they don't have room to grow really. So, and again, this right here, I would say give me about 35%. And you're like, what the heck's the 5% left? That's right, I duped you. 5% is going to be speculative. So speculative stocks are stocks that aren't proven. So they're not proven. They are potential. So these could be key players in the future. Just potential on those. Typically they have negative earnings, which, for each their own. I don't like companies with negative earnings personally, but if it's only temporary, that would be fine as well. So those are really the main things that I look at. So for speculative, you want something that would be a future good/service. So if you think now, you're thinking electric vehicles. That's a future good/service, but it all depends on the company, really. What's going on there? So fun stuff. I hope you are all happy. This is how I would consider investing. Well, actually, I should mention too. First, if you're gonna invest, you need a broker. So picking out a broker is a very easy one, though. It's as very simple as all of these brokers now are offering free. That's right, free trading. Which I think is crazy, but they used to pay commission fees, so every transaction you had to pay money to commit. Now it's all free, so we just really need to go ahead and enjoy those free things and join good companies like a TD Ameritrade, a Charles Schwab. I think I like Robinhood personally. I like M1 Finance. I have links for these in the description, so I hope you take a look at them. And let me know what you think of them. But this is how to invest in 2020. And I hope you enjoyed. Obviously, we finished it off by drawing this 5%, so that way no one gets too upset. So, hope you enjoyed them.